Good morning, Tuesday, September 2nd, 2025. Yesterday, Monday, was Labor Day. Hope you all had a great holiday. This is Herb Morgan, Senior Managing Director, Chief Investment Officer, Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary for the week beginning today. As a reminder, you can follow me intra-week. If anything comes up, I'll post it on either LinkedIn, Herb Morgan, or on X at Herb W. Morgan. Everything you're seeing and hearing is developed by me. It is designed to be used by you. It doesn't matter if you are a financial advisor or an investor. You are expected to make your own investment decisions. Nothing contained herein is investment advice. There's no tax advice, no recommendation for purchasing or selling any security. Everything is informational. The opinions are mine and mine alone, and they may differ from the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Well, we had a rare down week in equity prices as markets just sort of developed. Even though we had a really good GDP print, there was a bit of a sell-off. I think a little bit of that is profit taking. We've had a good run. We've been through this sort of recognition that, the Fed is more likely than not to cut rates this month. Now it's coming up. We're just a couple of weeks away. And you can see the economy, and the economy is remaining strong. You can see that manifested in the fact that high yield continues to maintain a strong bid with spreads being quite narrow. Lots of economic data last week. Let's start with new home sales in the month of July. Expected to go up, but they actually fell another 0.6%. They're down 8% on a year-over-year basis. That is largely a function of affordability. Affordability is at least partially due to payment, which is related to interest rates. The expectation that interest rates may start going down further. But we got to remember, too, there's just been a massive rate of growth in the cost of building, whether it's permits, impact fees, school fees, park fees, you name it, all the way to things like lumber, faucets, windows, doors, all of the above, have driven home prices significantly high enough to dissuade buyers. Speaking of residential real estate, we take a look at the FHFA Home Price Index. In June, it fell 0.2% and is now up a more modest and more normal 2.6% on a year-over-year basis. If you look at the Case-Shiller Index, similar results there. Fell 25 basis points on the month. Year-over-year gain is now just 2.14%. That helps. If incomes can start to go up and continue to go up, and if home prices can continue to moderate, that'll help. That'll help with the affordability situation. Pending home sales, those are homes that are in contract but haven't yet closed, fell 0.4% and are basically flat or up 0.3% on a year-over-year basis. We move on to durable goods for the month of July. They fell 2.8%. Not as bad as the 3.8% expectation, and not as bad as June's massive drop of 9.4%. You've now got 3 of the last 4 months there. You can see negative. Back out aircraft, though, the big non-defense aircraft orders, and we see that capital goods gained 1.1%. So not as bad as at least it first looked. We then got the 2 sentiment readings from the Conference Board as well as the University of Michigan. We will start with the Conference Board. They say confidence of consumers fell a little bit to 97.4. That was a little better than expectations, but below the July reading. The present situation component, how are things going right now, fell a little bit, as did expectations. Not a great report. All of this sort of softish data is giving the Fed, enabling the Fed and giving it the confidence it needs to be able to say, hey, we're going to cut in September. Remember, my view is they shouldn't. They should give inflation more time to come down. Price stability is their mandate. And unemployment at 4.2 is still pretty full. Michigan consumer sentiment, just like the Conference Board, fell from 61.7 to 58.2, below expectations. Current conditions also fell there, and expectations fell as well, just like in the Conference Board reading. On to the jobs situation. Initial claims for unemployment fell to 229, right in line with the estimate of 230. Continuing claims fell a little bit from 1.96 to 1.95. Moving on, we got this GDP revision. So we've got soft data, soft data, soft data, and then wait a second, second quarter GDP, which ended in June. The soft data was really mostly for July and August. Second quarter GDP, which ended June, was actually revised up, and it was revised up in a really good way. Not only did it go from 3.0 to 3.3, which is above the 3.1 estimate, but the things that matter most to the economy for long-term solid economic growth are consumption, personal consumption, that's you and I buying stuff. That growth rate was up 20 basis points from 1.4 to 1.6, and most importantly for long-term growth of the economy and jobs and consumers was business investment or CapEx. That was originally reported at a 1.9% annualized growth rate, and it surged to 5.7. Strong transportation spending, strong IP investment. This is talking about, what we've talked about is the build out, of this new AI economy and these massive data centers. All of this is positive for economic growth. Another reason I think the Fed probably shouldn't cut interest rates, but they will in September. We then got personal income and spending for July, up 0.4% on income, 5% year over year. Wages and salaries gained, that was nice to see. Personal spending gained as well. Okay, we move on though to the main issue, and the main issue is inflation. Inflation, as measured by the PCE, Personal Consumption Expenditures Index, in July was up 0.2. It was up 2.6 on a year-over-year basis. The core, which backs out food and energy, was up 0.3 and is up 2.9 year-over-year. The core PCE is the red line here. You can see no progress, zero progress in 2 years on inflation. We are just bumping along at just under 3%. So this is the Fed is in a bit of a quandary, right? We've got inflation above target. Unemployment is within range, but there are also signs that the economy is beginning to soften just a little bit. However, when you take into account the $6 trillion in expected capex that was negotiated it was negotiated as part of all these different trade negotiations, securing major commitments from both companies and nations to invest in the United States. Hard to think that's going to be anything but pro-growth. Why would you cut rates? Why would you need to cut rates there in that situation? And we move on here, and let's just change subjects entirely and talk about the fact that small cap stocks, since the beginning of August, have been really outperforming large cap and the S&P 500. So since the beginning of August, you can see Russell 2000 small cap stocks, they're up 6%, while the S&P 500 is up just 1.2%, and the Mag 7, all the big earnings growth, is up just 1%. Well, to be sure, those are both great numbers for a month. You make 1% a month on something, or 1.2, that's pretty good. But this was a significant turn of events for the Russell 2000 and for small cap. Multiple investment strategists across different firms in the last couple of weeks have been sort of echoing the call that maybe it's time to look more closely at small cap equities. In fact, I went and looked at the earnings growth estimates this morning on the Bloomberg terminal. So the fourth quarter of 25 is the blue. So the year-over-year growth Q4 to Q4 in the S&P this year is expected at 6. To be fair, it's been rising, that estimate. The Mag 7 up 14. But look at the Russell 2000 year-over-year growth estimate. That's not a typo. It's 57.7%. And for all of 26, we still see great things ahead. The S&P's at almost 12% earnings growth. Mag 7 about 14. Of course, the Mag 7 represents a massive part of the S&P. But small cap stocks, as measured by the Russell 2000, are expected to have earnings growth north of 35% last year. At the current time, those things could change. That is why you're starting to see people and institutions position themselves with more weighting in small cap stocks. In terms of economic data this week, Monday was Labor Day, so nothing was scheduled. This morning, we have already gotten S&P Global and ISM Manufacturing PMIs. They came in pretty good. Pretty good. You can see the estimates right there. Construction spending was down was expected to be down 0.2 month over month. Wednesday, we're going to have JOLTS or job openings, factory orders, Fed beige book, auto sales, and then on Thursday, regular weekly claims. And we get into the jobs reports. This will be the last jobs reports. These will be the ADP and the BLS, which will be on Friday, before the Fed meeting, which is the September 18th meeting. If those are soft at all, I think it virtually guarantees a rate cut, which I feel we are getting anyway, though we shouldn't unless these numbers soften considerably. If they strengthen, it might call into question that rate cut. We've got productivity, labor costs, trade deficit. Really haven't made much progress there. And the unemployment and the jobs report again on Friday. Thanks, everybody, for tuning in. This is Herb Morgan. I will be back to you again in 1 week. We will make the complex and complicated simple and sensical for you again next Monday. Thank you.